Hello everyone, welcome back to my channel. This time we'd like to make a brief introduction to the midterm quiz. Yes, and I can write some introductions and tips for my tomorrow's examination. To begin with, let's open the world. Yes. So for that, we can know that the schedule is only October 28th, only practical shells of building must be arrived at. Yes, on that case I need to copy that to my widget. First part for format for TMCQ for short answer and two exam question. Yes, the question will be conducted on inspired from. Yes, please read more instruction on how to set up your laptop with Inspire Informatics Examiner midterm quiz Inspire setup. Good. Please use the checklist to ensure that you understand key points and concepts. You can see that it's keys and yes. Well, we have in the last 5 videos we have done the textbook readings and vocabulary lists. And next is practice question. Practice 1, 2, 3, 4, 5. It is the yes, it's the case. So we'll do that in letter few letter time. And a new practice quiz has been created to help you with familiar with environment. The quiz can mimic the format of MCQ. Should also extend the question, present same set of questions. Each link provided has no limit, but for single use only. You encourage you to utilize action midterm quiz question from last term. Yes, the single submission. If you would like additional practice with attendee requests, introduction, the students have received 9. It is yes, this is the great. Okay, so this time let's do the first attempt just for open here. Thanks for assignment. Yes, start test. You can see that. So let's just to practice. You can see that there is 0 questions, 14 MCQs. Okay, let's go for that. So let me see how long it takes. Now it's 3 minutes. Let's go. First question is which one of the following statement is incorrect? Bills are already sold. The bills are always sold discount. Always sold. Now, if a commercial bank accepts the bill, this enhances credit quantity. If a commercial bill accepts the bills, if a commercial bill accepts the bill, this will enhance the credit quantity. Initial will seek to sell the bill at the highest yield. Incorrect. The bank increased creditness of the bill by acting as acceptor. A bank can provide both a bill accept facility and a bill discount facility. It's right. So let's see that. Seal the bill in the. So we need to like make some comments on here. So we can therefore question 1. Bills always sold the discount. Yes. If the commercial bank accepts the bill, this enhances the credit quantity. Quality of the data remnant. Sector issue the seal the bill in the. Sorry, I do not understand for that. Why it's. So it's about the price of the bill. I don't know. Crazy about that. I think C's run. The bank increased creditness of the bill by acting as acceptor. I don't know. 3D. Let's see logic here. The next one, question 2, is about which of all interesting would most like occur in the money market. Money market, capital market, and money market. 10 years now. A household takes out a mortgage with their local bank to a house. A household takes out a mortgage with the local loan branch to pursue a new home. Company conduct IPO. IPO commercial current issues looking notes with 6 months maturity issues treasury notes. Yes. Stock market, not the money market. Money market is short-term market. You require a bank loan that allows to manage small short-term seasonal variation in its cash flow. A small short-term seasonal variations in the cash flow. Small term, not small term. Called deposits, overdrafts, this type. Short-term loan instruments, called adoption. Seasonal variations. Seasonal variation. The type of loan I should obtain from bank. Seasonal variations. It's floating rate. Called deposits. Excuse me. Excuse me. Oh, what's wrong with me? Attachable equity warranted to a contract bond is still each warranty gives the holder the right to pursue ownership at a fixed initial price within 5 years, which will following business plan strategic purpose for the wholesale corporate if issue warranty in this contest. Each warranty gives holder detachable entity warranty into a corporate issue. So hold the right to pursue ownership at fixed price within 5 years. So it's right issue attached equity warranties to the debt issue and right to purchase ownership. The right leads convertible bond to protect existing shareholder from diluting existing. It can transfer the debt to the original share direct equity capital immediately at the time we issue. No, to convert existing debt obligation automatically into at maturity to ensure that all bondholders must know to make the bond issue more attractive to investors by providing the upside the long company to allow a lower. Yes, not automatically. The 5 years under the Basel III framework, which will most members will maintain the minimum capital ratio to suggest appropriate interest rate to ensure bank has sufficient capital to observe to control size to eliminate the need for B and D eliminate need for liquidity reserve. No liquidity reserve, but not guarantee that all loans may be risk-free, no risk-free at all time. So question 6 is calculation, so we can see that dividends, so 4.5 cents declared dividends which was payable on September the 14th immediately prior to declaration. The share price, we can know that the share price is $7.79 as the closing during on September. The share price at the close of trading on stock market on at the close of which really theoretical. What that mean? Immediately proud. Sorry, I'm just confused about the pronunciation. Prior to declaration dividends, the share price at close of trading on the stock exchange on 13. The price was so share price was prior to the declaration, and we need to divide 35 cents. It shall be the 3. Sorry, we need to use the calculator to make it available. You need to be familiar with that. $4.44. $4.44. Question 7 and 8. We can see that it's and consider new project. Kingston Capital initial investment for 600,000 in 4 period years. Can be sold if we project 80%. What is NPV of that in the next 5 years? So we need to try our timeline here. 0, 1, 2, 3, 4, 5. Next 5 years, and then sold for, we can see that initial investment is 600,000. Every each year we can receive 120,000. 120,000, and at the final year it can be sold at 90,000. So in that case, when you calculate the NPV of each one, so with 2 decimal including, so we need to see that. Sum up, we need to NPV R equals, so we need clear, so the NPV I is 8 and NPV is 220 equals to compute, sorry for that, so NPV 8, correct. Next NPV 100, yes, compute, sorry for that, enter 8%. So what does that mean? 8%. Sorry for that. Present value. Oh. Yes. Sorry, just forgot to use that. I'm just confused about how to use calculator. Sorry for that. I forgot it. So should Z well project or not? So it's obvious for the question. So let's go next one. Yes, I need to learn how to use calculator. So we need to open it. How to open the GPT. So sorry for that. 100. New compute, so not. So new cash flow. So for NPV, we need to enter the PV 8%, the present value, quit, compute, face value, sorry for that, we need to know I'm just confused about the calculator. I don't know how to use the Texas instrument, but we can get the logic correct. You can see that Awesome Pro issues 90 views with face value of the, so that's so we need to see the price when the face value is correct. So the calculation is that, so we can see that in the review. Sorry, close it. No, open it. Function will be there. Issue 90 days bill with a face value of the yielding at 90 days. So it's a short term. It's a short term. It's a calculation about. It's week 4. I mean. 90 days. Bill is yes, here when the yellow is known, we can know that the price is equal to face value. Face value equals to 2.5 million. 2 decimal place is the dollar effect on $1 times the days in year, and days in year, add up the yield percent, divide 100, and days to maturity. Days to maturity, we can see that. So in the calculator, times 90, divide 100, add up 665 equals to, says, index, so yes, so how to use that? Okay, great. 0 0.6 55 divided by 65.06 times 200, 2.5 million is 2 million 199, right? 2 decimal, it will be 2499,589.11. After 55 days, as I sell the bill in the free market, what the price will be sold for? So it's the same one with the it will be the same logic with different calculate amount. Yes, 6.0% divided by 100 times 35 days. It is yes, is correct. 6.6% times 35 divided 100, set up 6. So 755 is, and we use this one, and we times 605 times 250. Yes, 1499. A1682 2499 2499 A17.82. I mean, we should holding price. What is holding price earned by the orange? What is holding periodical earned by the, what do you mean? What is holding period yield? What does that mean? What is the holding per? What is holding what is holding period yield earned by the? Just curious about that. So just attempt, not the compare the R and PV value method in the method. Do these methods always leads to comparable recommendation? If not, so internal rate of return is compare concepts. Yeah, internal rate of return, the internal return is the, what is internal rate of return? And just so it will be in the chapter 4, week 4, internal rate of return. Sorry for that. No internal return. The discount rate that results in the is discount rate that results in the NPV equal to 0, which means the outcome is not percentage, sorry for that, percentage number when the amount is bigger than the required rate of return, accept the project internal is, what's wrong with this? The net present value is the difference between the present value of cash flow associated with present value of cash flow associated with the investment costs it's an absolute number when it's absolute, but it's a number, it's an absolute number when it is bigger than 0, except the project but it does not always lead to the comparable recommendations because comparable recommendation because for NPV that this method lead to comparable recommendation. What is does this method lead to comparable recommendation? Thus, it always leads to the comparable recommendation. So what should I say? Just my thoughts, just my consideration about the MPV. So we can see from that. A higher foot. So how to we should see that in because how to structure my answer, I don't know, I need to answer it, so just one by one. So when you see that a positive doesn't a positive MPV would will a positive will result in the what would do positive companies will avoid IND. Sorry for this. One R&D if they rely solely on the MPV. So on MPV companies and company will avoid IND development. IND if they rely on MPV. So we need to put 4 things: 2 in MPV and 2 in IRR, rate to return. Yes. And one higher MPV comparing a higher MPV does not always mean better. So always mean better. The maturity period and other factors are matter as well. For the IR, it is the percentage number which means the which is something which means the actual amount is ignored in comparison comparison but the working capital should be considered as well. Yes, that's all about the answering. We can see that the calculation. Reason why I cannot do the calculation is I failed to apply the I failed to use the calculator. So that's all about today's lesson. For the attempt for the written quiz attempt 1 answering. The next video we'll discuss the correction and do some adjustment and do some review on that. Okay, bye.